Module objective: to provide you with an in-depth understanding of the physical, institutional, and policy frameworks that make agricultural trade possible. This module explores the types, roles, and impact of agricultural market infrastructure and the pathways, channels, through which agricultural products move from producers to end users in both domestic and international markets. I. Understanding agricultural market infrastructure. Agricultural market infrastructure refers to the entire system of physical facilities, technologies, and services that support the efficient marketing of agricultural products. These infrastructures are the backbone of trade, as they enable farmers to connect with buyers, add value to their products, and access broader markets. Market infrastructure includes A. Physical structures, markets, roads, warehouses, cold storage. B. Supporting services, weighing, grading, banking, ICT, insurance. C. Institutional frameworks, policies, regulations, market information systems. Without proper infrastructure, even the best produce can rot, become undervalued, or never reach the market. This widens the rural and urban economic divide and discourages agricultural investment. Second categories of agricultural market infrastructure. 1. Physical infrastructure. These are the tangible built structures that support the storage, movement, and selling of farm products, rural roads and transportation. Enable movement of produce from farms to markets. Poor roads increase time, costs, and losses. B. Market centers and trading hubs, open and enclosed spaces, rural periodic markets, urban wholesale markets, international commodity exchanges, where buyers and sellers meet. C. Storage facilities, warehouses, silos, cold rooms. They prevent spoilage and help stabilize prices. D. Processing units and abattoirs, located near farms or markets. Add value to raw produce. E. Packaging and grading centers. Provide standardized packaging and classification services to enhance quality perception. F. Weigh bridges and measurement facilities. Ensure transparent transactions between traders and producers. Second, information and communication infrastructure. A. Market information systems, MIS, platforms that provide data on prices, demand, weather, and buyer locations. Examples: radio bulletins, mobile apps, extension services, digital platforms like AgroMall or Hello Tractor. B. Digital infrastructure, e-commerce websites, agricultural marketplaces, and mobile payment systems facilitate faster, wider reach for agricultural trade. Third, institutional infrastructure. A. Commodity exchanges and trading boards, platforms for bulk buying and selling of standardized commodities. Example: AFEX, Nigeria, Ethiopian Commodity Exchange, ECX. B. Regulatory agencies, set and enforce trade policies, quality standards, and licenses. Examples: SON, NAF, DAC, NASC, NAQS, Nigerian Export Promotion Council. C. Financial institutions, offer banking, mobile money, insurance, and credit to farmers and traders to ensure liquidity and risk protection. Third, agricultural trade channels. Trade channels refer to the routes through which agricultural commodities pass from producers to the final consumers. Each level in the channel adds value, price, and sometimes inefficiencies. A. Types of trade channels. Traditional trade channels. A. Farmer local trader equals to wholesaler retailer consumer. B. Still common in rural areas circa prone to price distortion and poor quality control. Direct-to-consumer channels. A. Farmer consumer, via farm gate sales, farmers markets. B. Farmers earn more, consumers pay less. C. Not suitable for large volumes. Contract farming and aggregator channels. A. Farmer aggregator processor or exporter. B. reduces marketing risk, promotes quality and traceability. Digital or e-commerce channels. A. Farmer online platform. Customer. B. Uses mobile apps and platforms, e.g., Farm Crowdy, Thrive Agric. Requires tech literacy and good logistics. Export channels. A. Farmer or cooperative exporter, foreign buyer or retailer. B. High returns but stricter standards, traceability, certification, packaging. IV. Role of government and private sector government responsibilities. A. Develop roads, rail, and rural infrastructure. B. Establish regulated markets and grading standards circa. Encourage farmer cooperatives and associations. D. Provide market data systems and training. E. Subsidize storage and cold chain investments. Private sector contributions. A. Build warehouses, logistics chains, and ICT systems. B. Operate e-marketplaces and trading platforms circa. Offer input credit services and insurance. D. Form partnerships with smallholders and cooperatives. V. Challenges in agricultural market infrastructure. A. Inadequate rural infrastructure, bad roads, poor electricity. B. Lack of storage and cold chain systems. C. Weak regulatory enforcement. D. Poor access to market data for smallholder farmers. E. Middlemen distortion and unfair pricing. EAF. Weak institutional coordination. 6. Opportunities and future trends. A. Agritech platforms providing real-time market access and pricing. B. Commodity exchanges expanding to smallholders. C. Public-private partnerships, PPPs, in market infrastructure. D. Blockchain and AI for transparent commodity tracking. E. Cluster farming and aggregation hubs for scale. Summary. Market infrastructure is essential for efficient agricultural trade and income generation. Trade channels determine how value is added or lost from farm to fork. Poor infrastructure equates to high post-harvest losses, low farmer income. Government, private sector, and farmers must collaborate to build sustainable systems.